Right then, folks, let's get straight into it. Last week we looked at something something completely different, to be fair. What we did, literally just off the cuff, was a little touching slightly on strategy development. Basically just taking an idea and kind of what to do with it. Now, I would like to follow a similar train of thought on this week, and something I've been talking about quite a bit in my own training sessions with my own group, and that's really to kind of challenge what you know to be true about technical analysis. Personally, my view is that what's discussed in most textbooks, while it's great for a knowledge point of view, a knowledge base, from an actual practical trading point of view, most of the time it's completely inaccurate. Now, it's not to say that it wasn't accurate at any point, it's just at the time of writing, lots of the conclusions that were drawn from the author probably were correct at the time. But the markets change, the dynamics of these things do change, conclusions can obviously change with new information. So what I'd like to try and do is just literally get you into the habit of trying to challenge what you know to be true. And again, we're going to go through, again, kind of like that strategy development idea, and looking for evidence to support the idea to see whether that idea does have any viability from a trading point of view. Now, we took an indicator at random last week. This week I'm going to select one just for speed and simplicity. But all right, you tell me. Let's throw the question open for the moment. We're going to look at inside bars. Inside bars. An inside bar is a bar with a high-low range that is inside the previous bar's high-low range. So, for example, let me just zoom in. So, for example, a bar with a high-low range that is inside the previous bar's high-low range. Oops, and I'm just marking an example off now. So we've got, again, just in case you weren't sure, an inside bar to me is a bar with a high-low range that is inside the previous bar's high-low range. So what do you know about inside bars? You tell me. Let's have a little bit of interaction this week. So what do you know about inside bars? Has anyone ever researched them? Indecision, to pause, to narrow range. You can trade the break up or break down. Now that's an interesting point. So thinking about it from a trading point of view, it can happen before an engulfing bar. Again, even better plan. So yeah, there's certain things, that you can draw some conclusions from with, any particular pattern. And the things that we're going to go through, this kind of process that I'll be going through, we can apply this, as we saw last week, to literally any idea or any observation and see if it's got any viability from a trading point of view. Now then, so what the textbooks say, what the common consensus about inside bars is that, yes, it is. It's a period of hesitation, of indecision, of narrow trading. There's no significant bias between the buyers and sellers. But from a trading point of view, the general consensus with an inside bar is the size that the inside bar breaks is typically the short-term direction. So what a lot of people do is trade inside bars. Whenever there's an inside bar seen on the chart or develops on, whatever time frame that you happen to be looking at, the size that that bar breaks is typically the size that is traded, and typically you could expect price to follow through in that direction. Now, who's ever traded that particular strategy? Who's ever traded an inside bar? So you see an inside bar, buy the high, sell the low, whichever side triggers first, the other side becomes your stop loss. Again, that's the general consensus of an inside bar strategy. Again, it's very basic, it's very foundation. You could obviously tag on other things to that. But that's the general consensus. Who's ever traded that type of strategy? Alright, thanks for the interaction. Yeah, it can get bad in periods of consolidation, and obviously you'll see multiple narrow ranging bars, if you like. To be fair, it's usually a strategy that most people tend to have a go at some point. It's quite a common one. What I was hoping that there was a few more people that had tried it, so we can try and get some interaction and draw some conclusions from your experience from this. So we know that the general textbook view is that when there's an inside bar, buy the high, sell the low, whichever side breaks first is the side that you trade on, and the opposite side becomes your stop loss location. So to answer your question, what do you mean by the size the bar trades? So basically, the general consensus with an inside bar type of strategy is that you would place a buy order above the inside bar, a sell order below the inside bar, and then if, for example, the price moves above the high of the inside bar first, then you would be entered long into the market and you would have bought that particular instrument that you're trading. The low of the inside bar would then typically become the stop loss. So it's kind of like a bracket trade. Again, that's the general consensus for an inside bar strategy. Now, that's what the textbooks say. It's quite common. You can pretty much find it most places on the internet. You can find it in several textbooks. But again, let's come back. Let's challenge this. This is what the textbooks say. So, what do you know to be true? So few people have traded this. Has anyone researched what the textbooks have said? Let's throw it a little bit more general as opposed to an inside bar. Has anyone ever read something, a particular strategy or a philosophy about how to deploy a trading strategy, and just taken whatever you've read, literally for granted, and that is the truth? Has anyone ever sat back and actually thought, is it actually true? Has anyone ever thought that? What I'm trying to get you to do is to think about, there might be one on Forex Factory. I don't typically troll the forums myself, but yeah, there are strategies all around it. So there are strategies out there. Most new traders say, yeah, that seems like a great idea, and then just go with it and just take it for granted that that is the truth. But what do you know to be true? So let's do what we did last week. Let's find out what we know to be true about inside bars and compare it to what the general consensus actually is. So inside bars, just to remind ourselves, an inside bar is a bar with a high-low range that is inside the previous bar's high-low range, hence the inside bar terminology. Now, just one that jumps off the chart here, just where the cursor is now, and hopefully you can see the highlighted blue area. We can just see the cursor here. Inside bar, that bar there, has a high-low range that is inside the previous bar's high-low range. So again, the general consensus with this type of formation is that buy the high, sell the low, whichever side triggers first is obviously your entry. In this case, the high breached first, so you'd be long, and the opposite side would be your stop loss. Again, that's the general consensus. So we've got one example here where buying the high or selling the low would have worked out effectively an inside bar breakout. The resulting activity after that was a fairly reasonable movement. So that kind of lines up with what we know from the textbooks and what the textbook example says should happen with an inside bar. Now, just for speed, I've got a little widget on my platform that marks off all the inside bars. The yellow dots, can everyone see the yellow dots? The yellow dots on the charts are what this charting platform determines as an inside bar. So we can see at a glance, very quickly, where the inside bars are. Again, just for speed, it just helps to speed things up, because we've obviously got a very short period of time in our usual session. So we're going to come back to, again, very similar to what we did last week, what do we know to be true about an inside bar, and compare that to the general consensus of what the textbook tells us should happen with an inside bar. So again, we've got an area on the chart here arrow on the chart here. Again, just what a yellow dot is, we've got the inside bar, and again, the general consensus is sell the low, buy the high, whichever side triggers first is your trade, and you should go with that direction. Again, we've got lots of examples of inside bars. Now, what should happen according to the textbooks is the side that breaks first is typically the short-term direction. And again, we've got one good example here of what the textbook told us should happen. But is that in actual fact true? So we've got inside bar here, start from the left-hand side of the chart, inside bar here first. The side that breaks first is up, and then in fairness, it breaks down, up, and then eventually sells off. So that's not what the textbook tells us. Now, again, another trap you can fall into with this particular setup is you can literally end up stopping and reversing. So you can buy the high, sell the low, the price goes down, you end up selling the low with a stop above the high, and you could literally flip long, short, as in this illustration here. So that's one danger to be aware of as well. Another illustration here, the high inside bar, the side that price breaks first is typically the short-term direction. Now, I don't know if you can just see that here, but the side that breaks first is actually the low. And again, the textbooks tell us that the side that breaks first is the side that will be the short-term direction. Now, quite clearly, that's not the case here. So we've got some contradicting evidence at the moment, based on the short sample set that we're looking at, that disagrees. We've got quite mixed view with what we know to be true about inside bars, but comparing that to the general consensus of an inside bar. So again, more examples here. We've got two back to back, where we've got inside bars, and again, the high is breached on both of those first, but then what happens? Price essentially turns around in the opposite direction. So again, that disagrees with the textbook version of events. Inside bar, price breaks the high, what happens next? Price turned around. Inside bar, price breaks the high first. In this case, that one agrees, we've already identified this, that one agrees with the general consensus. So already what we've got, by doing a little bit of research, just a little bit of visual backtesting if you like, to see if the idea that the textbooks tells us about an inside bar, being that whichever side the inside bar breaks first, is the side that should be traded and will dictate the short-term direction. Now what we know out this very short sample set already is that's just not the case. It might have been 100 years ago when that was first identified, but right now, based on our observation, again, to come back and the original question, the purpose of this session is to challenge the general consensus of any trading idea, any concept, and compare that with what you know to be true. Does everyone kind of understand the logic theme? This was the theme that we were looking at last week. Just taking a different spin on it and looking at, instead of an indicator, which we looked at last week, but inside bars. Again, the same logic. Challenge what you know to be true. So we've got an idea, which we might have read on the internet. I don't know. We might have read it in a textbook. Trading inside bars. What do we know about inside bars? There's plenty of strategies about. We've covered them. And what I'm doing right now is I'm just highlighting the inside bars so that we can see and compare what we know to be true with the general consensus. Now, we're going to take this idea, that general consensus, compare it with what we know to be true, and then see if we can adapt the general view with facts, what we know to be true about this particular setup. So what I've just done now, I think, again, just spent a little bit of time while I was summarizing, just highlighted the areas of the inside bars so that we can see and compare what we know to be true with the general consensus. So already we're making observations. Again, this is again touching on what we talked about last week. This is essentially how I would assess an idea, any idea, to see whether it's got viability from a trading point of view. Does the idea I have, does it measure up against reality? Is it just fanciful? Again, challenge everything you know and everything you're told about trading. Don't take anyone's word for it. It might be a great idea. It might work out to be a great idea when you research it. But the point is, with any strategy, with any idea you have and you're looking to trade it, you need to research it. You need to challenge it. Does what you know, is what you know to be true? Is it true? Research it, develop it, back test it, forward test it, sideways test it, challenge it, and make sure that idea ultimately is going to make you money. More specifically, that you understand the idea and that idea can be made money. It might be that relative to the market that you're looking at, it might need some adjustments. It might need some tweaks. So let's look at that now. We've got an idea, buying or selling the break of an inside bar. But what do we know to be true? The general consensus, and in my own observations, outside of this short sample set, in my own observations, what I know to be true about inside bars is the complete opposites to what the textbooks tell us. Again, the textbooks tell us the side that the inside bar breaks is the side that price generally moves. Now, I know that not, again, for the purpose of Steve, I know that not to be true because I've researched it, I've tested it, and hopefully I'm trying to share this with you, with the general philosophy of challenging what you know. And what we can see is this, again, plenty of examples, just where the cursor is here. The side that the inside bar breaks wasn't the side that then we saw a subsequent movement. It was, again, a false break, if you like. Price moved in the opposite direction. We've got an inside, it's not actually picked, it's not an inside bar actually. We've got an inside bar here, the side that the bar broke. It broke the low first, then turned around and moved in the opposite direction. The side that the bar broke, on this one here, it did move down, only very briefly in fairness, so temporarily the textbook was right. But then what happened? It didn't create the subsequent movement that the textbooks tell us. Next, just where the cursor is now, inside bar. The low broke first, then what happened? Price turned around and moved in the opposite direction. Just here, price moved through the low first. Again, temporarily, it was right. But then what happens? It took a little bit longer to develop this time, but what happened? Price moved eventually in the opposite direction. This one here where the cursor is, textbook was right. Buy the breakout would have worked out just great. Short-term direction identified. Lower the bar broke again. Another one where the textbook worked out right. The short-term direction was right. So what we know to be true, again, we've got another one here where that would have worked out fine. The next one here, the high broke first, so it would have been wrong. And eventually, the short-term direction was the opposite direction. So, the point I'm trying to make is, the textbook was wrong. Sometimes it was right, sometimes it was wrong, but more often than not, just with this short sample data that we have on a 60-minute chart on the euro, what we know from the textbooks doesn't line up with reality. So I'll just pose the question before we move on. Would you trade that strategy? Buy the high or sell the low of an inside bar? Again, it's a very popular strategy. It's nice, in fairness, it's nice and simple. So it's a very popular strategy. So with this little bit of knowledge, just by challenging the idea and doing a little bit of research, would you now trade an inside bar breakout? Would you buy the high or sell the low? Just with that small piece of information and literally 10 minutes of quick observational research, would you trade it? Okay, so again, no, not really, the general consensus. So, alright, so the idea, the general understanding of how an inside bar should be traded, again, when it was first identified, it might have been fine. Again, challenge what we know. You've got to remember that most technical analysis books were written, 50 to 100 years ago. Now, while the pattern itself might still be a regular and recurring pattern, how to actually deal with it based on what we know to be true might have changed. So what we know to be true now is that more often than not, the side that the bar breaks, the inside bar breaks, price typically and more commonly goes in the opposite direction. So can we put some structure on this? Alright, the idea initially on face value, it wasn't fantastic, but it doesn't mean it's not tradable. We might need to make some tweaks and some adaptations. Absolutely, yeah. We're going to go on to that now, Nathan. We're going to basically look at some, potential filters. What can we do to see if this is a viable trading? Let me just delete some of these markings just to make the chart clearer. Just bear with me a second. What can we do to actually make? What can we do to make this this inside bar trading strategy? What can we do to make it tradable? Well, first off, could we add a filter? Could we say, all right, well, there's the inside bar. Let's just mark off the low and the high. The general consensus is buy the high, sell the low, whichever triggers first is your short-term direction. And it's just simply not the case. Now, we've already observed one instance. We've already observed one instance where price has messed us around. You would have going above the high and the low at the inside bar. Buying above and selling below the high and the low of the inside bar would not have worked out. You would have got this effectively expanding volatility pattern. So let's try and take this into consideration. This might help us to give us some grounding, some foundation to try and help us avoid this particular situation, and also might lead into fairly interesting movement afterwards. So rather than use the high and the low of the inside bar, could we try and add some type of filter? What if the low or the high is just breached by a few ticks? So let's perhaps think about using the previous bar as our trigger to take action. So rather than use the inside bar, could we add a little bit of a filter in to dictate what we consider that movement past the break past the inside bar? Now in this case, by doing that, firstly we see price move above here, and then we get this nice shooting star. So there's another observation. So what we're starting to do now is build observations with how price interacts with that trigger level that we've just adjusted. We've got a nice shooting star, and again, the short-term direction was down. Now, if we stay with that, price in fairness did turn around and then subsequently developed what you might term as a dark cloud cover to use some candlestick formations. So this might in itself be, one of those unique patterns where price starts off. Let's just scroll back behind the time. Price starts off with the inside bar, small consolidation. We see a break of the high, break of the low in this case, and then a break of the high. Now notice the highs. The highs have very stereotypical reversal bars. Shooting star, dark cloud cover. That might actually be, we note the observation down, that might actually be a reoccurring pattern. It might not happen very often, but it might certainly be a pattern worth exploring again in the future. So this is where I'd note that down and say, okay. Anyway, so where were we? So we're starting to build up observations. Now I appreciate it's still a little bit vague at the moment, but all we're dealing with is trying to get an idea to try and find, a trading pattern, if you like. So in this case, what we have now is we've got an inside bar. We've put a little bit of a condition on. Instead of using the inside bar high and low, we're using the previous bars high and low as, a potential filter to try and avoid some of that unnecessary heartache that goes along with the general textbook version of how to trade an inside bar. But what we end up doing now is we end up making some observations when we start to assess the patterns as they develop and unfold. And what we're looking at now is effectively a volatility expansion. We've got price making highs, lows, higher highs. This might actually be one of those unique patterns that develops from time to time that starts off with the inside bar. So does everyone kind of get the logic? Challenge what we know to be true, make observations in price, and see what happens around it. So this pattern that we've identified, again, it might not develop frequently, but what do we know to be true about the pattern? Well, it led into, in fairness, we have the benefit of hindsight here, but we have a situation where it led into a good movement. And it all started off with an inside bar. So this would be one for the notebooks. This would be perhaps a more detailed pattern leading on from the inside bar. So personally, we're just going to be looking at the inside bars. So this for me would be something for further research. Perhaps take a screenshot of it. See if we can identify similar patterns that have developed where we start with an inside bar, price breaks the high, the low, the high, or the other way around, the low, the high, the low. And we get an indication of potential direction with more classically defined candlestick patterns. So a little bit more involved for that one, but just from some initial research and literally observations, we're changing what we know to be true about our interpretation of inside bars. And that inside bar could lead into, effectively, fantastic pattern. Let's move on to the next one. Let's take that consensus again. We've got the inside bar here. What are we basically looking at? We're going to filter it down. We're going to use the previous bar's high and low range. We've got this little yellow dot here, the inside bar. So what do we know? So what do we know? Well, the textbook says the side that the inside bar breaks is the side of the short-term direction. Now, in this case, the next bar here where the cursor is now, the low of that inside bar is breached, but we've added that filter by using the previous bar's high-low range. And it's not yet being breached. And it's only here that price breaches that, effectively, that filtered trigger level to take action. So what do we know about this one? Well, it worked out. In fairness, it was short-lived, but price did move in the right direction. It did move temporarily, although very briefly, in the right direction. But eventually, price turned around and obviously went in the opposite direction. So we've got one short-lived pattern. We've got an inside bar that led into an expanding volatility pattern. Let's look at the next inside bar. We've got the inside bar here. Instead of using the high or the low of the inside bar, we've used the previous bar's high-low range to dictate our trigger levels to take action. That's what we'll consider the break, as opposed to the high and the low of the inside bar. So what do we know to be true here? We've added that little bit of a filter. Price attempts to break out. We've got price turning around. So we know that. We've already made the observation that the side that the inside bar breaks is typically, that price then typically moves in the opposite direction. So we start to make observations. What have we got? Appreciate we've only got a short space of time. Appreciate we've got a short space of time. And I'm kind of rushing through things in fairness. But what we're trying to build up is a knowledge base and compare the inside bars with what we know. We've added a little bit of a filter on this, just to try and give us a reference point with a little bit of a mechanical structure. Inside bar here. Price, again, we know this one's already one that the textbooks agree with, so we can pretty much move over that. Again, the inside bar, what we know to be true is that the opposite, or the side that the inside bar breaks, price typically moves in the opposite direction. But can we filter it down to see if the breakout does actually work? So using the previous bar's high-low range, we've got that again, that's false break. Again, another very stereotypical reversal bar. We've got that bullish engulfing just there as our trigger to take action. So what are we starting to build up? We've already got one observation. If we just zoom out, we've already got one observation where price breaches those adjusted trigger levels and develops reversal bars. We've now got another example here where price breaches the adjusted trigger levels for the inside bar and develops a reversal bar. So now we're starting to build up some very interesting observations. the trigger levels that we use when we see a reversal bar can then lead into a more significant movement than developing an inside bar. Sorry, than trading the break of the inside bar itself. So rather than the general conclusions I've come to, again, I appreciate that I'm glossing over, I am rushing through these things. The conclusions I've come to from a long time looking at these things is with inside bars, firstly, don't take the textbook's word for it. Secondly, challenge whatever idea that you have. It might be that on face value, the general consensus is that it's not a fantastic idea how it's presented. But with observation and some time invested and a little bit of research, it might be that with some adjustments that you can, some adjustments and observations in price activity around this particular pattern, we can develop a viable strategy based on what we know to be true. Now, what I know to be true with an inside bar and this type of setup is that when price moves through the trigger levels and then develops these types of reversal bars, and again, we've got plenty of examples here. We've got, again, so just for speed mark them off, we've been through a few examples, so I think we get the idea. Inside bar, previous bar's high-low range, it gives us trigger levels. Price moves to those trigger levels, we've got one marked off here, and then develops a reversal bar. So we start to build conditions, and that starts to form the basis of a strategy. So inside bar, mark off the previous bar's high-low range, wait for price to penetrate one side, and see if it develops a reversal bar. That then leads into a more interesting movement. And this is what I know to be true. We start to put some conditions and it develops a strategy. Inside bar, mark off the high-low range, price moved, no reversal bar. Note the inside bar, mark off the previous bar's high-low range, wait for price to penetrate, does it develop a reversal bar? In this case, piercing line, stroke engulfing bar again. That's then led into a more significant movement. Inside bar, over here, inside bar, mark off the previous bar's high-low range, wait for price to penetrate. Does it develop a reversal bar? A little bit of a grey area. This one was a little bit messy. One down bar, one up bar, then price penetrated again. Exclude that because it was a little vague. But nevertheless, we start to build a foundation based on observation and add conditions in, which can lead into a strategy. Inside bar, mark off the previous bar's high-low range. When price penetrates either side, does it develop a reversal bar? In this case, no, it doesn't. Once again, no condition, no trade. Inside bar, mark off the previous bar's high-low range. Does it develop a reversal bar on penetration? In this case, no, it doesn't. So we'll start to see the kind of benefits of what we're looking at and what we're doing. All we're simply doing is challenging what we know to be true with what the textbooks tell us. It doesn't mean it's wrong. It simply just means that it might need adapting and updating to the 21st century. And from that, we can start to make observations. And with those observations, develop conditions. And with those conditions, they develop rules. And with those rules, all of a sudden, we develop a strategy. Andy, you can, to be fair, if you want to. Depends on the research that you conclude. So the question was, why can't we say it's a low percentage win strategy but has a high risk reward ratio? You can do. It depends on the conclusions and the results from your testing. Again, we've only got a very short space of time, so again, I am glossing over a lot of things and going through things quite fast. But again, the purpose that I was hopefully trying to illustrate was very simply just to get you to challenge everything that you're told when trading. Just because someone tells you doesn't mean it's gospel, it's the truth. It might be a great idea, it might seem like a fantastic idea, but test it, back test it, research it, and more importantly, make your own opinion on the idea or the strategy that's being presented to you. Draw your own conclusions. it might be that you observe a better way to do it. Now, in my own experience with this very simple illustration of an inside bar, the textbooks, for me personally, I think are completely wrong in this case. The side that the inside bar breaks is not the side of the short-term direction. More often than not, price breaks say below the inside bar and then turns around. That's basically what I've observed in my own experience. So the side that price breaks the inside bar, price typically turns around and goes in the opposite direction. That's my own observation. And from that, we can start to develop perhaps some conditions, some rules, some adaptations. And again, in my own experience, this, pretty decent setup, pretty reasonable. With a few conditions, we end up with identify the inside bar. So here we go, example at the bottom of the screen. Identify the inside bar. Mark off the high-low range of the previous bar. Mark off the high-low range of the previous bar. Then wait for price to penetrate and see if a reversal bar develops. If a reversal bar develops, your hammers, dojis, shooting stars, piercing lines, dark cloud cover, and so on, that typically leads into a fairly reasonable movement in the opposite direction, the side that price broke on. Again, that's my observation. But again, don't take my word for it. Challenge it. Test it. See if it works. But again, we've taken the original textbook observation with inside bars. We've challenged it in real time. What do we know to be true? More often than not, when this condition happens, we get some pretty decent setups out of it. We've already got one up here on the left, which led into a very big movement. We get some really good observations in price that might develop into a viable trading strategy. Keep it simple. You don't have to overcomplicate this. Keep it simple. Use the high and low of the reversal bar. So the condition for the entry for me is so the strategy would be inside bar. Mark off the high-low range of the previous bar's high-low range. Wait for price to penetrate one side or the other. When price penetrates, does it develop a candlestick reversal bar? In this case, it's where the cursor is. It's a engulfing bar. Buy the high of the reversal bar. So my entry would be above the high of the reversal bar. Stop loss past the low, and take it from there. But again, do your own research. It might be that you don't need to wait from your own research with this particular pattern. You might not need to wait for it. You might just say, on that bar's completion, your analysis might conclude, market entry order. So again, do your own research. The fakie setup, again, that's another one in itself. A fakie setup, in fairness, they develop all over the charts. They develop quite a lot. But what we've done is we've added in conditions, just based literally on observation. No, but it starts off with an inside bar. What do we know about inside? Very simply, you don't trade an inside bar. Because the textbook says you sell the low, you buy the high of an inside bar. What we started off with was an inside bar. And we made observations around the inside bar and how to potentially trade an inside bar pattern. Selling the low and buying the high, as the textbooks tell you to do so, for me, that's the quickest way to lose money. But can we take that idea, that concept, and develop a viable strategy? That was one of the purposes of what we did last week. That's what we've done this week. Right, folks, any questions? Again, the main purpose of it this week was basically challenge what you know to be true. That's essentially what I was trying to get across. Don't take anyone's word for it. It may be a great idea, it may be a great strategy, but test it, back test it, research it, understand it, challenge it. Can you make it better? What are your observations? It's a constant cycle of asking questions. It's not necessarily the inside bar strategy that I was trying to get across, folks. It was the concept of challenging what you know to be true. And make sure you test and do your due diligence when you're developing or even learning a new strategy. So, any final questions, folks? Okay then, with no final questions. Thank you very much for attending. Thanks for your interaction. Thank you as always to FX Street for hosting these sessions. And I will see you all next time.